The industrial zone of Singapore hums with the rhythm of steel and fire. Sparks illuminate the air, and the smell of molten metal lingers heavily. In that heat, a single company works quietly but purposefully: OMS Energy Technologies. At first glance, it might seem like a conventional manufacturer, but beneath that surface lies the beating heart of the global oil and gas infrastructure. To bring crude oil from deep underground to the surface, one indispensable system stands guard: the surface wellhead. It controls the enormous pressure beneath the earth and connects the wellbore to the production facilities above. A single design flaw here could result in catastrophic blowouts or uncontrollable leaks. This is a domain where precision is not optional. It is survival, and only companies with decades of proven technical mastery, rigorous safety records, and international certification can compete. OMS Energy Technologies embodies that pedigree. Headquartered in Singapore, the firm operates across Saudi Arabia, Malaysia, Thailand, and Indonesia, and boasts over half a century of technological legacy. On May 13, 2025, it achieved a milestone: an initial public offering on the Nasdaq. The stock debuted at $9 per share, issuing about 3.7 million shares and raising approximately $33 million. In most cases, this moment marks a company's coming of age. IPOs tend to attract strong investor enthusiasm. Stocks often climb in early trading, or at the very least hover around the offering price for months. But OMS Energy Technologies defied that pattern. Within weeks of its debut, the stock began a steady decline, sinking to the mid-$3 range within months. For investors, it made no sense. Financial statements were solid, profits rising, and liabilities well managed. The most recent filings showed revenue of around $200 million and net income of roughly $44 million. That's not a struggling company. With a price-to-earnings ratio of just 3 times, the valuation was inexplicably low compared to industry peers. By any conventional metric, this should have been a bargain, and yet the market turned away. The first explanation was predictable: the lockup expiration. After an IPO, insiders are restricted from selling their shares for a fixed period. When the restriction lifts, short-term price dips can occur as those insiders cash out. But such dips are normally brief, lasting a few days or perhaps a week before rebounding. In OMS's case, the fall stretched for months. It wasn't normal profit-taking. It was something else. The second theory blamed emerging market exposure. OMS had expanded aggressively into volatile regions like Pakistan and Indonesia, and where currency swings, regulatory barriers, and political instability often spook investors. But again, such risks are nothing new to